Recording in progress.
Hi, a very good morning. This is your friend Shorodip Dey. Now, today we are going to look at the dollar index. Look at this dollar index. What is dollar index? Dollar index is relative value of dollar with respect to a basket of currencies like euro, Japanese yen, Swedish krona, like that. So, here is the dollar index chart. And in very recent times, you can see over the years, this was the time when COVID arrived. When COVID arrived, what you saw? You saw that Federal Reserve started printing a lot of money. Here I go to the chart of the Federal Reserve. See, when the Federal Reserve started printing a lot of money and pushing into the economy to save the economy from a sudden crash, they expanded the balance sheet from 4 trillion to almost 7 trillion immediately within a very small amount of time, right? Within a month or two, from March to, you can see, till May 18, suddenly they increased the balance sheet by almost 3 trillion, which is almost, if you see, 75% of that time what that existed in the balance sheet. Now, what happened after that is that immediately the dollar index, because the supply of dollar increased suddenly and maybe the other economies were not increasing, not printing money at that pace, the dollar declined to a level of 88, 89. But what happened after that? Because US economy was very resilient after that, after the initial downfall, initial contraction, the US economy bounced back very strongly. And compared to many other economies, US economy was doing well. And that is why, because there were uncertainty all around the world, but US economy was doing well, the dollar started going up. And add to that, there was high inflation that actually prompted Fed to increase rate. Here I am going into the chart of US federal fund rate. So here you can see the US federal fund rate, and here you can see the US interest rate. So because there was inflation that was raging at that point of time, people started anticipating that Fed will increase interest rate, and which actually started from effectively from February 2022. And Fed started from 0.25. It's gradually over the period of 22 and more slowly during the 23 until the July, Fed slowly increased the interest rate. Initially, it was very fast, but in 2023, it was gradual. It increased the interest rate to 5.5%. That is quite a bit of high interest rate in terms of the US economy. Now, the inflation actually remained very resilient, right? And that's why Federal Reserve also, if you can see, after increasing the initial expansion of the balance sheet was very fast. But after the June of 2020 till February of 2022, the Federal Reserve increased its balance sheet gradually till a peak of almost 9 trillion. You can see 8.9 trillion. And from March 2022, it started declining the it is started decreasing the balance sheet, which presently stand at 7 trillion, still pretty high compared to what we used to have for a decade before the COVID pandemic. Now, how dollar index behaved to that? Initially, because the inflation was high, but also the interest rates were going high, the dollar index also started going up till the point of November, you can see 2022. And the level, I think, was 114 for 50. And suddenly, as you can see, that Fed started actually uh, here you can see the Fed started that they were ending the rate hike cycle. And this is the Fed fund rate, which is almost one US 1 month uh, yield, you can see, which goes hand in hand with the US interest rate, that you can Fed decided interest rate. So as Fed was nearing, because market always anticipate the next phase of the cycle, and as soon as the market understood that the Fed rate hike cycle is coming to an end and possibly inflation was moderating a little bit, the strength in dollar index actually gave in. And what we saw, and though Fed was decreasing its balance sheet slowly, but it was not fast enough. People understood that so much high level 114, 115 in dollar index was possibly not the right thing. And during that time, if you see, there was Russia-Ukraine crisis that actually emerged, the Russia-Ukraine war, and that also resulted into a little bit of lack of interest in dollars, in terms of that many countries were fearful, which were adversaries to USA, that USA may not honor their dollar claims later. So due to that reason, what you can see is that dollar index actually declined suddenly. Now, when dollar index declined suddenly, it found a base near 100, 100.5, 100.6. And since then, as Fed was contemplating when it can cut the interest rate, you can see that the dollar index hovered in between. And based on data, when the inflation was coming hot or cold, the job data was coming hot and cold, the dollar index actually fluctuated between a narrow range of 100.5 to 107.5. Now, and the broader range actually, barring this top, you can see this is weekly chart of dollar index. It was 100.5 to 106, you can say. Now, recently, as Fed has found that the jobs are cooling off in USA, cooling down in USA, and the inflation is also quite benign, the Fed has, in the Jackson Hole, Mr. Powell has made it very clear that he is going to the path is clear, only the pace and when it happens, it will depend on data. So the market is pricing in very correctly that possibly the interest rate will cool down. And as the interest differential between USA and other markets come down, as you know that ECB has already started cutting rate, Fed has not yet done. RBI has not yet done. So as at the, and there is a apprehension that Bank of Japan may actually increase the interest rate. So there is a little bit of apprehension, and that is why it is quite obvious that as US interest rates are about to go down, and US interest rates have been flat for quite some time, you can see. So as there is more probability of nearing a time when we may see a cut in September itself, you can see dollar index is revisiting 100.5. It may breach 99.5, which was a support in July 2023. And if it breaks, we can see quite a bit of fall, possibly towards 95, 96. If I draw a Fibonacci retracement of this move, 98, 99, below that 94.627. So these will be very important levels. Now, because everything in the world, because this is dollar is the reserve currency in the world, when dollar comes down, you will see that globally all assets, all risk assets, especially emerging market equities, the Dow, the commodities, especially gold and silver, all of them may get a boost if dollar comes down, because everything is measured in dollar. The crude oil, the other commodities, the metals. There is worry about metals due to China probable slowdown, but what you may see suddenly is that when the dollar started coming down, all the emerging market equities, the risk asset, uh, and today gold, silver, because they are somehow measured in dollar, they are not risk asset in that sense, but they may also rise along with the decline in dollar. So this is very crucial. The next set of data that we are going to look at is the September job data and the September job data non-farm payroll that will come in, and the September inflation, the September PMIs that will come in early. These are August data that will come in early September, and we have to note what, how, and to what extent Fed reacts to that, Fed's Powell reacts to that. So very important. So for all, whatever assets you may be trading, maybe it crypto, maybe it precious metals, maybe equities, you have to keep an eye on dollar, because the world revolves around dollar, and when the reserve currency of the world moves, it has major implications for all the risk assets globally. So thank you. This is for you. I will upload more videos. I hope you like it and enjoy it. Please subscribe to the channel and like and share if you enjoyed the video. Thanks. This is all from my side this time. Thank you very much.